Ever wondered if owning a home in a major city like Toronto feels like, well, just an impossible dream sometimes?
Yeah.
The headlines about housing affordability, they can be pretty overwhelming, right? Always hinting at a crisis. But what's really going on beneath all that?
Hmm.
Today, we're taking a deep dive into the Toronto housing market. We want to unpack its affordability, look at what the future might hold, and see how it stacks up against other big global cities.
Right.
And we've pulled together quite a bit for this, a really rich stack of sources. We've got an extended analysis of median multiple ratios going way back from 1985 right up to 2025.
That's a long view.
It is. Plus detailed affordability trends, some fascinating international comparisons, and even a specific forecast looking at when the market might bottom out and start to rebound, looking out to 2030.
And our mission here really is to try and cut through all that complex data for you. We want to highlight the most important patterns, maybe some surprising facts too, and ultimately help you get a real grasp on the true state and, the likely path forward for Toronto's housing landscape. We're aiming to make sense of it all so you walk away feeling well informed.
Okay, so let's unpack this. Where should we start? Maybe with that core metric you mentioned, the median multiple.
Yeah, that's the perfect place. It really helps us understand affordability.
So what is it exactly? It sounds a bit technical.
It's actually pretty straightforward. It's just the average home price divided by the median household income before tax.
Okay.
So think of it like this. It tells you how many years of a typical household's income it would take to buy an average home.
Got it. So a lower number is better, means more affordable.
Exactly. And to give you a really crucial benchmark, what we call the international comfort zone for a healthy housing market, where home ownership is generally sustainable for, the average person, that's typically a median multiple of 3x to 4x.
3 to 4 times income.
Yeah.
Okay. That's our baseline for what's considered affordable globally.
Like the benchmark, yeah.
So let's trace Toronto's journey then, starting way back in 1985. Where were we then?
Okay, 1985. Get this. The median multiple was just 1.7x.
1.7, seriously.
Seriously. Our sources describe this as extremely affordable. It's just such a stark contrast to today, isn't it?
Wow. Less than 2 years of income. It almost feels like a different world, like you said, almost fictional today. That's not just affordable, that's genuinely accessible.
It really hinted at a market where ownership was a foundational part of economic stability for a lot of people.
Okay, so what happened next? Did it stay that low?
Well, by 1990, we saw a jump. It went up to 3.6x.
Ah, okay, so creeping up.
Yeah.
Still in that comfort zone, though, just.
Yeah. Some of our sources call it a bubble-era excess for the time.
Right.
But it's pretty remarkable looking back that 3.6x was considered an excess, given where we are now. It was still within we'd now call moderate norms globally.
And then things settled down for a bit.
They did, yeah. From about 1995 to 2000, the ratio was really consistent. It hovered between 3.0x and 3.3x. In this period, it's often described as the market stabilizing to healthy market levels. A genuinely balanced time.
So the late 90s were kind of the sweet spot then.
You could say that. But then, a really significant shift started. In 2005, the ratio jumped to 4.7x.
Okay, now we're clearly past that 4x upper limit of the comfort zone.
Exactly. This marks the point where our sources say marked unaffordability begins. The market sliding firmly into overvaluation, exceeding that international comfort zone, was kind of the first big warning sign.
Was there any relief after that?
There was a slight dip in 2010. The ratio cooled a bit to 4.3x.
Okay, a small improvement.
Yeah, but crucially, you're still above those healthy comfort zones. It showed the underlying pressure hadn't really gone away.
Right. And then what happened next? Because I feel like things really escalated after that.
Oh, they did. And this is where it gets, really interesting and frankly, pretty alarming. By 2015, Toronto hit 7.9x.
7.9, that's almost double the comfort zone limit. What drove that? That feels like a massive leap in just 5 years.
It was huge. That period saw this really potent combination of things kicking in. You had historically low interest rates, which made borrowing super cheap.
Right.
You had significant population growth boosting demand. And critically, a continued scarcity of new housing being built.
The supply just wasn't keeping up.
Not even close. It created this perfect storm where demand just massively outstripped supply, pushing that median multiple into what our sources call explosive unaffordability among the highest globally at that time.
Wow. Okay. And did it go even higher?
It did. The absolute peak, at least according to our analysis, came in 2020. We hit 9.6x.
9.6 times median income.
Just incredible. That must have felt like extreme pricing pressure.
That's exactly how it's described. Extreme pressure across the board.
So where does that leave us now, looking at 2025?
Well, the projection for 2025 is 8.7x.
Okay, so down a bit from the peak in 2020.
A bit, yeah. A slight improvement, as the analysis puts it. But let's be clear, 8.7x is still critically stretched. It's way, way beyond sustainable levels for the average household. Right. So even with that minor dip, the fundamental challenge is still massive.
Immense, yeah.
What a journey, from 1.7x all the way up to nearly 9x. So if you had to boil it down, what's the single most crucial takeaway from this whole historical look?
I think the overarching story is really clear. Toronto's ratios, they were in that affordable, maybe mid-range sweet spot from 85 up to about 2000.
Right.
But from 2005 onwards, the market has just consistently drastically exceeded those healthy levels.
Yeah.
It really entered what you have to call bubble territory.
Especially between 2015 and 2020 with those 8x to almost 10x multiples.
Exactly. And even now, in 2025, that projected 8.7x ratio, it's still 2 to 3 times higher than sustainable levels. It just confirms this ongoing stress and persistent overvaluation for the average household. It's like a fundamental reset of what normal means for housing in this city.
Okay, that historical perspective is sobering, but it leads to the next big question. Toronto's 8.7x, is this just a Toronto problem, or are other major global cities facing the same kind of thing? How do we even compare?
That's a great question. And what's really fascinating here is to use something called the demographia scale. It's a widely accepted way to interpret these affordability ratios globally.
Okay. How does that work?
It gives you categories. So for you to put Toronto's numbers in perspective, anything less than 4x is considered affordable.
Right, our old comfort zone.
Exactly. Then 4x to 5x is classified as seriously unaffordable.
Okay.
And then anything over 5x, well, that falls into the severely to impossibly unaffordable category.
Severely to impossibly. Wow. Okay, that's the lens we need.
That's our lens for comparison, yeah.
So let's do some comparisons then. You mentioned the U.S. before. How do major U.S. cities stack up against Toronto's 8.7x?
Right. Looking at the big U.S. metro areas, you see some really eye-watering numbers too. New York City and San Francisco, both are sitting at 10.0x.
And times income, okay.
Boston is a bit lower, but still high at 7.7x.
Yeah.
In Chicago, no, it's not on the highest list, but the U.S. national average for major metros is around 5.6x.
5.6x average. That itself is already in that severely unaffordable zone, isn't it?
It absolutely is. Gives you a sense of the scale of the issue across North America.
Okay, what about other parts of the world known for expensive property? Like Australia.
Australia. Yeah, they provide some of the most striking examples of unaffordability on the planet. Sydney. Sydney is at a staggering 13.8x.
13.8.
Yeah. And it's explicitly described in the data as impossibly unaffordable.
I believe it.
And Melbourne isn't far behind, sitting at 9.8x, also clearly labeled impossibly unaffordable.
Wow. Okay. And what about London? Always hear about how expensive London is.
Yep, London in the UK. Greater London's ratio, it typically falls somewhere in the range of 9x to 12x. It can vary a bit depending on how you measure it.
Okay.
But demographia data from a few years back, 2019, put around 8.2x. Still very much at the severely unaffordable end of things.
So when you put all these cities side by side, Toronto, New York, Sydney, London, what's the big picture telling us? It really seems like all of them are way past just seriously unaffordable.
You've absolutely nailed it. The overarching conclusion is that all these cities we've listed, Toronto included, they definitively exceed that threshold for severe unaffordability.
Right.
Cities like Sydney at 13.8, New York and San Fran both at 10x, they're unequivocally in the impossibly unaffordable category. No question.
And the others.
Melbourne, London, Boston, they're in the high single digits,
Mm-hmm.
which is still extreme compared to those healthy global norms we talked about, around 3x or below.
So Toronto's 8.7x puts it right in the thick of it.
Absolutely. Squarely among these global leaders in unaffordability, it really cements its position in a pretty challenging group of cities.
Okay, so we've clearly established Toronto's housing is incredibly expensive. Historically, globally, the picture is stark. But what about the future? Where's this market headed in the next few years? What does all this mean for you, our listener, maybe thinking about buying or selling soon?
Right, that's the million-dollar question, isn't it? So right now, mid-2025, Toronto's housing market is really in what we'd call a correction and plateau phase.
Correction and plateau. Okay, what's driving that?
It's largely driven by this mix of factors. On one hand, you've got Stubbornly high interest rates.
Yeah.
The Bank of Canada's overnight rate is still over 4.75%.
Uh-huh.
You've got sluggish wage growth, which dampens buying power. But then you have these powerful counter forces,
Right.
record levels of immigration pouring in, creating constant demand, and critically, still not enough new housing being built, limited housing starts.
So those forces are kind of balancing each other out, creating this plateau.
Exactly. It's creating a very tight balance right now. It's sort of tense stability.
If we look back again, just briefly, what do historical patterns tell us about how long these kinds of adjustments usually last before we see a real recovery kick in?
Yeah, history gives us some clues, but it also shows that every cycle is a bit different.
Right.
So, for instance, after that 1989 bubble burst, it took about 6 years, 89 to 95, for prices to really find their bottom and then start a sustained recovery.
6 years. That's a long time.
It is. But then, more recently, after the 2017 foreign buyer tax shock, things moved faster. It took about 18 months for prices to stabilize and start bouncing back.
Okay. Much quicker.
And then the most recent cycle, the 2022-2023 rate hike period, Toronto prices dropped maybe 12-13% from peak to trough,
Uh-huh.
but they actually recovered faster than some other markets.
Yeah.
And a big reason for that seems to be the sheer volume of immigration demand cushioning the fall and speeding up the rebound.
Interesting. So history gives us different timelines, 6 years, 18 months, a faster snapback recently. With that in mind, what are the likely scenarios for when prices might finally bottom out this time, as of mid-2025? What's the most probable window?
Okay, based on the analysis, we can sketch out 3 probable scenarios, each with a different timeline.
Let's hear them.
First is the soft landing scenario. This assumes we start seeing gradual interest rate cuts from the Bank of Canada, maybe late 2025.
Right.
In this case, we'd expect prices to bottom out sometime in late 2025 to mid-2026, so roughly the next 6 to 12 months. And this is seen as the most likely window.
Okay, 6 to 12 months. That's scenario 1.
Scenario 2 is the hard landing. This would involve a more serious economic downturn, maybe a recession, significant layoffs. If that happens, it would likely push the bottoming out further, probably into mid to late 2026. So more like 12 to 18 months from now.
Right. A tougher economic climate delays the recovery.
Exactly. And then there's scenario 3, sticky inflation. This is where inflation proved harder to tame and interest rates have to stay high well into 2026.
Okay.
In that case, the bottoming could be delayed even further, potentially until 2027 or later. That pushes the timeline out to 24 months or more.
So quite a range of possibilities, but the most likely bet, given current forecasts, is that bottoming out happens sometime between late this year and the middle of next year.
That seems to be the central expectation, yeah.
Right.
Provided the Bank of Canada does start easing rates by late 2025.
Okay, so once the market does find its bottom, whatever that is, and we enter this rebound phase,
Yeah.
what kind of price growth are we talking about? Are we expecting another crazy surge like we saw before?
That's a really important distinction to make. No, the forecasts are much more conservative this time. We're looking at an expected compound annual growth rate, CAGR, of maybe 4% to 5% per year from 2026 through to 2030,
4 to 5% a year, okay.
which over that period translates to a total price growth of somewhere between 17% and 22%.
Okay, so steady growth, but not explosive.
Exactly. And if you look even further out, say from 2026 to 2035, the expected CAGR is maybe 4% to 6% annually. That would lead to a total price growth over that longer period of roughly 48% to 79%.
Still significant growth over a decade, but more measured.
More measured, yeah. But there's a big caveat here, always.
Ah, okay. What's that?
This all assumes we don't hit a major global recession, and crucially, that the housing supply in Toronto remains constrained. Those are key assumptions. So we're not talking speculative bubble-like gains again. It's more about modest, consistent appreciation driven by fundamentals.
Right. And speaking of fundamentals, what are the specific key triggers that would really need to happen to drive that market recovery and the rebound you're describing? What should people be watching for?
Our sources point to 5 key triggers. First, and probably the biggest one, is the Bank of Canada actually cutting interest rates, which, as we said, is mostly forecast for late 2025.
Okay. Rate cuts are number 1.
Number 2 is wage growth finally starting to catch up with inflation, maybe even exceed it a bit. That puts more real purchasing power back in people's pockets.
Makes sense. More affordability.
Third, immigration needs to continue strong. That forecast of 500,000 plus newcomers per year arriving in Canada, many heading to Toronto, provides consistent underlying demand.
Okay.
Fourth, and this is critical on the supply side, housing starts continuing to lag behind that population growth. That supply-demand imbalance remains key.
So not building enough homes continues to push prices up, essentially.
It's a major factor, yes. And finally, number 5, seeing global investors start to return to urban real estate, viewing Toronto again as a stable, attractive, long-term investment.
So rate cuts, wage growth, immigration, low supply, and returning investors. That's the recipe for the rebound.
Those 5 factors together, yes, would undoubtedly fuel the market's recovery, according to this analysis.
Wow. Okay, this has been incredibly thorough, a really deep dive into Toronto's housing market. We've traced its journey from, well, shockingly affordable back in 1985 to becoming extremely overvalued by 2025, putting it right up there with the world's most expensive cities.
Yeah.
And we've also unpacked the specific factors, the interest rates, immigration, supply issues that are likely going to shape its future in the short to medium term, including that potential bottoming out, maybe late 2025 to mid-2026, followed by a more gradual, steady rebound.
So as we sort of wrap this up and look at these projections,
Mm-hmm.
even with a potential rebound and what we're calling, modest appreciation down the road, it really does raise a critical question for you, our listener, to think about. What does this trajectory truly mean for the dream of owning a home in a city like Toronto, especially for younger generations, for people just starting out, or maybe even for the social fabric of our communities?
Right.
If continued strong immigration and that persistent lag in housing supply are indeed the key triggers for future price growth, what deeper societal questions does that raise about long-term accessibility and the future of home ownership for generations to come, even if the growth itself is projected to be modest?